Hello and welcome to this session. Today we are going to talk about investing the Warren Buffett way. My name is Subodh Bire. I'm going to be your host today, and I'm a big Warren Buffett fan. I've been learning investing for the last couple of years, and also invest in the stock market actively. And I got really interested in this topic maybe a couple of years ago when I started reading about Warren Buffett and Charlie Munger. And there's one book which I'll recommend at the end of this session, which you guys should really check out, which is called Essays of Warren Buffett by Lawrence Cunningham. Like that's where I started my journey, and it's been a very exciting journey ever since. So let's get started. So why study Warren Buffett? And the track record speaks for itself, but Buffett has been compounding his capital for the last 70 odd years, probably more than that. And if you look at his record, like 31% annual return for his Buffett partnerships from 1957 to 1968, compared to the market return of 9%. Similarly, his Berkshire Hathaway, when he acquired it and he started compounding through that, uh, he achieved around 20% for 60 years compared to S&P 500 average return of 10%. And when we study Buffett, we get different parts of like great bits of investing philosophies from Ben Graham, Charlie Munger, Phil Fisher, and Buffett has used all of these methodologies at different stages of his life. He's openly shared his investing philosophy, and it is a long-term sustainable way of compounding wealth. Uh, Buffett and his principles, including Graham and his principles, have worked for 70, 80 odd years, and probably more than that, 90 years since security analysis was released. So it has worked for a long, long period of time, which means that it is sustainable and it can work in the future. What made Warren Buffett relentless? And it's a really interesting question because I've been reading The Snowball, which is a biography of Warren Buffett by Alice Schroeder, and she talks about how early Warren Buffett was intense. Like this guy was reading books all the time. Like he'd read most of the books from the Omaha Library. He's read the Moody's Manual twice, which is a 10,000 page compendium or something. So this guy is intense. Like he's consuming everything in his sight, and that's what he keeps doing his entire life. Like he just keeps reading, keeps learning, and keeps accumulating that knowledge. And that intensity is what made Warren Buffett super successful. And one of the things that he used to say is that he's able to make decisions very quickly, and the reason he was able to do that because he understood that particular business. He understood the nuances because he has read about everything about those businesses beforehand. So he already has that knowledge, and he's able to make decisions very quickly once an opportunity is presented to him. And that's what he did. He created a prepared mind. And Charlie Munger has this quote saying, opportunity comes to the prepared mind. And Buffett was preparing his in his early years. Buffett was preparing his mind and making sure that he consumes as much knowledge and insights as possible. He read a lot of biographies. He kept learning, and that I love this quote by Buffett, which says, "Intensity is the price of excellence," and that's what Buffett did his entire life. Like he did not let anything and anyone come in his way of compounding, and that's the game he wanted to play his entire life. And obviously temperament as well. Like Buffett was super rational. That doesn't mean he did not have emotions, but he was able to control his emotions and act in a very rational way when it came to stock market investing, and that's what made Buffett successful. One is the good news. Let's always start with the good news, as they do, and we'll talk about the 7 investing principles. And there's some free resources at the end that I wanted to share so that you guys can keep learning and keep going on this journey. A bit about myself. Like my name is Subodh, as I said earlier, and I'm a chartered accountant. I have a stock portfolio. Uh, I also have a small e-commerce store called Tiny Tycoon, where I create this merchandise like coffee mugs and wall art and figurine and notebooks. And I use quotes and caricatures from Buffett, Charlie Munger, Elon Musk, Steve Jobs, and other investors and entrepreneurs. So that's what I do. But I primarily love investing, and that's what I'm here to share. So the good news is that it is possible to be a good stock picker, an excellent stock picker, and it can be done today as well. You will hear a lot of stories about, oh, Buffett did it in the 60s and 70s where things were different. Of course, things are different, but you will still find pockets of opportunities in all markets, and you will find at different times and periods of time in history. So you just have to keep learning, have the patience to wait for the right opportunity. Obviously, put in time and effort, which I'm sure you guys will all do. But having that mindset, having that mentality, saying it is going to be possible and I'm going to do it, like I think that belief is quite important. I have learned it the hard way, saying you have to believe that, and if you don't believe it, you're not going to be you're not going to get there. And that's true for whether you're doing investing, whether you're running a business, whether you're running, a marathon, or whether you're playing a sport. Like you have to believe, and you have to believe that it can be done and can be done well. And Buffett believed it, obviously. And when he was in his teens, he knew that he was going to be a millionaire because he understood compounding, which we'll talk about in a few seconds. And he really believed that he was going to be a millionaire by 35. And in that era where, the Great Depression had just happened, like that seemed quite a big, like a monumental task. But Buffett knew what he was doing. When Buffett was a teenager, he did everything and anything he could do, run his own business, buy stocks, whatever he could, to achieve that first $10,000, because he knew that once he had a good amount of capital to invest in, he could put that money into the stock market. And he was selling Coke cans door to door. He was throwing newspapers for a living. He had like a pinball machine business where he would install secondhand used pinball machines in barbershops, and he would share the fees with them on a 50% basis. So he made a lot of these small, you know, uh, so he created these small business ventures so that he could accumulate money as fast as possible. And that's the relentless nature of Buffett that we were talking about. So today we are going to talk about 7 investing mantras of Warren Buffett, starting with compounding, and then moving into circle of competence, stock being an ownership stake in a business, competitive advantages, or moats as Buffett like to call them, long-term mindset and cultivating that, understanding the difference between price and value, and margin of safety. So let's jump into the first one. Has anyone heard this story of chess before? It's a very fascinating story which tells us about the the nature of compounding and how it is not intuitive. So the story goes that there was a king in India. He loved war games, and he asked a sage to create a war game for him, like build it from scratch. And then the sage builds this game of chess, and the king is mighty impressed. Like he loves it. He's like, I'll give you one wish, just go and ask me for whatever you want and I'll grant it to you. And the sage goes, thank you, all I want is 1 grain of rice on the first square, and which keeps doubling on every subsequent square. So 1 grain of rice becomes 2 on the second square, and 4 and 8 and 16 and 32 and 64 and so on. And and the king goes, oh, that sounds like a very simple request. Sure, I'll grant it. Like, you can take you can take that. It's just grains of rice for him. And a week later, the king finds out that there's not enough rice in the kingdom to fulfill this request, because the answer is 9.2 quadrillion grains of rice. Quadrillion is 15 zeros. It is so incredible. Like, it's so hard to believe that 1 grain of rice can become 9.2 quadrillion grains of rice in a matter of a chessboard. And that's the nature of compounding. Time does most of the work, and compounding is not intuitive. And I'll give you another example of that. I'm sure you would have heard of this one. Like, if a penny keeps doubling every day for 30 days, what is the answer? And the answer is $5.3 million. This is mind blowing. And if you visualize these compounding uh, outcomes, rice grains or doubling a penny or Buffett's net worth, all of them will follow this very similar pattern, where most of the gains come at the end, and see that gigantic spike up and on the right. And if you look at Buffett's net wealth, 99% of his wealth was generated after the age of 80. He's 93 now, so in the last 10 years, he has accumulated a huge amount of money compared to his previous 80 years. And Morgan Housel has this quote, which I love, which is called, Buffett's skill is investing, but his secret is time. And Buffett knew this very early on as well. Like he used to always, and he still says, when I die, people should say, "Oh, this guy was so old," and that's what he wants to do. Like he wants to keep living as long as possible so that he can keep compounding and play this beautiful game that has been playing for the last 80 years. One of the important things that Buffett always said was rule number one, which is don't lose money. And he said that also, which connects nicely with compounding, was that if you lose money, the compounding engine stops and it gets disrupted very, very severely. And that's why he wanted to make sure that it doesn't lose money, so that the compounding engine is not stopped and keeps going up and up and up. And of course, having said that, Buffett did lose money from time to time, but it wasn't material enough to significantly deteriorate his wealth. And his winners always exceeded the losers, so the winners take care of the losers, as always in investing. And that's what helped Buffett to catapult his wealth over time. The key tenets of Buffett's investing was this concept that he talks about, which is circle of competence. And what circle of competence is the deep understanding of a particular area, be it a domain, be it an industry, be it a business, be it a particular skill, and how he used that concept in investing is he asked himself these couple of questions, saying, "Do I understand how the company makes money? Do I know what its competitive advantages are? Will the company exist 20 years from today or not? And what is the probability of that prediction?" And he relied very heavily on knowing one thing, which is the predictability of the business, the predictability of revenues. And there's an interesting story that Buffett narrates in 1998, like one of the lectures that he gave in the University of Florida to the students there. And he talks about Microsoft. And remember that Buffett and Bill Gates were close friends, and Buffett admired Bill Gates, but he still did not invest in Microsoft. And one of the reasons for that was that Buffett could not predict what Microsoft would be 20 years from now. And even Bill Gates wouldn't have predicted, where Microsoft would be, because the nature of these technology companies back then and even today is that it's very hard to say for sure that this particular brand or this particular business will exist. Like we all know, for example, in today's world, that AI is going to be the future. But it's, at least for me, it is very hard to say, is that going to be chat gpt, which will still dominate 20 years from now, or is it going to be something else? Or whether large language models will still be a thing, or it might be taken over by something else. Who knows? Like, will be talking to robots? Like, we don't know. I don't know, at least. And it's very hard because of that to say that it's not within my circle of competence, clearly. uh, and and so that's what Buffett did. Like, he used this circle of competence and he tried to stay within the boundaries of the circle of competence. And like, if you think about investing, the two hard pile is quite a great tool, where you can just say, like, the opportunities or stocks that you don't understand, you can just put it in the too hard pile, move on to the next opportunity. You don't have to take all bets that you come across. You can just be very, very selective with the stocks that you're buying. And that's what Buffett was doing as well all the time. Like, he knew that Coca-Cola, for example, is going to survive 20 years from now, and that's why he kept holding Coca-Cola, and he bought Coca-Cola in the 90s when Coca-Cola was doing its global expansion. So he came in at the right time, and he knew there was predictability, there was a strong competitive advantage that he could rely on, and there was mind share that he talks about. Like, when people think about soft drinks, they think about Coke, and that mind share was very hard to disrupt. And one of the things that is quite a key way to think about circle of competence is when Charlie Munger was asked, like, how do you know whether something is within your circle of competence or not? Because sometimes it can be a bit gray, or it can be on the edge of your circle. And Munger, yeah, said in response that if you're asking the question, then it's kind of answering the question, because if you're not sure whether something is in your circle of competence, it probably isn't in your circle of competence. The next thing I want to talk about is the other principle that Buffett took from Ben Graham. Ben Graham was the father of investing, and he very clearly stated that a stock is not just a ticker symbol, but it's a fractional ownership in a business. And it is really important, this principle, because it changed the way I think about stocks. Because I'm not just looking at that, quote that I received today, saying, "Oh, it trades at 125, and then tomorrow it goes to 126, and I'm tempted to sell." But if I look at it from a perspective that, oh, I'm an owner in a business, and I don't just want to sell because the stock went up by 1% or 2%, and that brings that ownership mentality. Um, Buffett always talks about, if you're owning a house and someone comes every day and gives you a price for your house, and sometimes it's 1% up, sometimes it's 2% down, will you still sell the house, like based on that quote that you receive every day? And the answer is probably going to be no, because you want to own the house, you want to live in it. And that's the way to think about stocks as well. Like you're trying to be an owner in a wonderful business, and you want to keep holding that wonderful business. So that's the way to think about stocks. And I thought it was a very important principle, at least for me, to have that right frame of reference when you're thinking about stocks and investing. The next one is economic moats, and I'm sure you guys would have heard of this. Buffett talks about it all the time. And moat, simply put, is in the olden times, there used to be, the castle, and you want to protect the castle. So you create this kind of pond around it or a moat around it so that it's protected. And that's what Buffett wants in a business. He wants the business to have a moat, a castle with a moat, and then he wants sharks and crocodiles in that moat or in that pond so that it protects the business from competition or from outsiders. And what are the different kinds of moats in a business? Um, so brand is obviously one of them, and Buffett has invested in a lot of brands. Like if you think about See's Candy, Dairy Queen, Coca-Cola, Apple. He has invested in these well-known brands because he loved the power of brands. He understood the power of brands, especially after he bought See's Candy, which he paid a big price for at the time. Like it was $25 million for around $4 million of pre-tax earnings. So it was quite a big price to pay, but it was something that he learned over time, that if he's able to capitalize on the brand has, especially Seeds Candy, had earnings power, so he could increase the prices, and he had that pricing power, which he could capitalize on and generate even more earnings for the business. And that earnings power gave Seeds Candy what Buffett thought was a great margin of safety and a great return on his investment. The other type of economic moat is low cost providers. So if you've heard of Geico, when Buffett bought it in the 60s, Geico was basically servicing government employees. So the insurance policies could only be sold to government employees, and these people are more law abiding naturally. So Geico had that advantage of like picking a good subset of customers who generally behave well. Geico was the auto insurance provider, and also the way they distributed insurance policies was via post back then. So it was going directly to the customer, and it was asking them to sign up to Geico's insurance policies. And what that did is it basically cut out a lot of costs. It completely eliminated the middleman, which is the insurance agent or broker, and which meant that Geico had the lowest cost in amongst the competition, and that's what gave Geico the advantage. Similarly, cornered resource, something that just one company can do but others can't. Scale is another big advantage. Like the hyperscalers today, the Netflix, Google, Amazon, Meta. These are hyperscale companies, and it's very difficult to compete against them because they operate at such a massive scale. Switching costs, I think the best example nowadays is the cloud service providers. So if you want to move from Amazon AWS to Google Cloud, it's very, very difficult, very, very complex, tricky to move from one provider to the other. And that gives a massive advantage because if you have those switching costs, the customer is more likely to stay with you, and which means that you have more predictability and more recurring revenues coming in the future. Now, I put Mindshare here as well, but Mindshare and brand are kind of similar, but not the same. So, Mindshare, for example, is dominated by just one brand in a particular category. So, if you think about mobile phones, you would think about Apple, they have the Mindshare. Doesn't mean they're the best, but having that mind share in the customer's mind is a massive, massive advantage. And it's very hard to change that as well. Like the consumer psychology gets wired over several years. And if you want to change that, it's going to be a long game. What is the power of these moats? Like, what does it give you? What it gives the business is domination. So once you have a moat, a competitive advantage, a monopolistic position, it is very, very difficult for competition to come in and disrupt you. And what that means is that you have predictability of recurring revenues in the future. You have pricing power. You can increase prices on customers, and they won't have a choice to but to stick with you because there's no one else providing the same value or the same service that this business is doing, and which means that you get high returns on capital, and high returns on capital is how you can compound your wealth as a business. And if the business keeps compounding its cash flows, then it will reflect eventually in the share price as well. So that's what economic moats can do to a business, and um, that's why Buffett approached or valued that. The next one is long-term thinking. So if you think about the average holding period for a stockholder in the stock market today, it's 6 months, and that's a really short window of time. Like if you think about the amount of time that it takes for change to occur in a business or growth to occur in a business, 6 months is not enough of a window. And what Buffett did was think about it in long-term horizons. He looked at businesses that he could predict which would exist in the next 20 years. He had a long holding period. Like, in fact, his quote is that his favorite holding period is forever, and he has held some stocks for 40 odd years. So he has been a long term shareholder and a long term partner. He had that ownership mindset. So a stock like Coca-Cola, he's held it and still holds it. It's been around 40 odd years since he's held it. And and also, while Buffett was on top of daily news, macroeconomic events, and potential of stock market crashes. Like, he didn't focus on the macro or this kind of noise. Although he was across it, he wasn't like overly concerned. Um, and the quote from Buffett, which says the stock market is a device to transfer money from the impatient to the patient, and that's what he was going for. He was going for that long-term horizon, long-term thinking, and that gave him a competitive advantage compared to other investors, compared to Wall Street, who were looking at the next quarter and next 6 months. Like Buffett was looking way beyond that and looking at a long-term horizon. The next one is talking about value versus price. And Buffett has this quote saying, "Price is what you pay, and value is what you get." And a lot of people don't pay attention to intrinsic value, and they just focus on the market price. They're looking at market price fluctuations and movements and charts, but quite quite a few people, I mean, a very few people will actually look at intrinsic value, like understand the intrinsic value. So what is intrinsic value? It is the cash flows that a company will generate from its business from today up to eternity. So until the business ceases to exist. And the way to calculate that is by using what we call as the discounted cash flow calculator. I have a link at the end of the presentation, which will give you a free DCF calculator from the Corporate Finance Institute. So feel free to use that. But the idea here is that you want to understand how much cash is the business going to generate from today up to when it stops earning money, and you want to discount it at a reasonable rate. I use 10% as the discounting rate because I want at least a 10% return on my capital. So I use that as the benchmark, or as the minimum threshold. And what I would do, I mean, what Buffett says is that if the cash flows that the business is generating, if that is if that value is higher and significantly higher than the current market price, that's where the opportunities lie, and those are the opportunities that Buffett always chased. And if you look at an average stock price chart for the entire year, let's say, you will see that, if you look at the 52-week high and a 52-week low, you will find that there's a huge difference. Sometimes it's like 50%, 60% between those two numbers, and which means that the stock market is, rising and falling. Like, the stock prices are falling and rising, and those are the opportunities that we could capitalize on. So if we know the value is not going to change significantly within a year's time frame, but if the market value, the market price keeps changing, we can be patient and wait for the right opportunities in that kind of a scenario. And if you think about investing, like you might think, oh, this is a 100% rational game. Everyone is thinking rationally and behaving rationally, but there's a big part of investing which is the investing psychology. And Buffett, or rather Ben Graham, had a term for the market which is calling it Mr. Market and calling it maniac depressive. So the sometimes market is very exuberant and they just think everything is going to be great, everything is going to be rosy, and everyone starts buying stocks and the market keeps going up and up, as it happened in 2024. um, and at the same time, the other situation can also arise where there's fear and anxiety that investors will face at certain points. If you remember back in 2022, there was a lot of talk about recession and slowdown, and that created a lot of fear and anxiety amongst investors because of higher interest rates, and that caused the market to go down significantly. So fear and greed is what drives the market, and there's a lot of herd mentality in investing, and that's where once you know that you can use it to your advantage. It also means that at times you're going to be lonely because no one else is going to think the way you think, and that can be very very challenging at times, but also rewarding if you bet on the right things, and if you wait and be patient, the market will eventually reward you. And Joel Greenblatt always says that when he teaches students, he says that if you do good valuation work, the market will eventually reward you, but he doesn't say when. He doesn't give a time frame because it's very hard to predict that time frame. But eventually, the market will come around and see the value that you see in a particular stock if you do the right kind of work. The next principle is margin of safety. And this ties nicely into our previous slide about intrinsic value and price. And this principle, like if you think about engineering, when engineers build a bridge, they want to build a bridge which will sustain for a long period of time. And what they do is, let's say, they'll build a bridge which will sustain 15,000 kilos of weight, although the maximum expected weight bearing that the bridge will do is, let's say, only 10,000 kilos. So that's what you want to do. Like you want to create that margin of safety because you don't want the bridge to fall over. If that 10,000 becomes 12,000 on some days, you want to have enough of margin. So that's the same concept. And in investing, the way Buffett used that was to look at the difference or the delta between market price and intrinsic value. And he was looking for those opportunities where that delta was massive. He was not looking for something which was only 10% undervalued or 20% undervalued. He was looking for something which is massively undervalued. And what it does is it reduces your investment risk. If you think about investment risk, it is basically the permanent loss of capital. So how do you reduce that? If you buy something like way below its intrinsic value, you are reducing the risk of permanent loss of capital, which doesn't mean that you will avoid temporary loss of capital. Like let's say if you buy a stock at $10, the intrinsic value is 25. So you might feel happy that you bought it at 10, but then that 10 might become 5, in a year's period. But that doesn't mean it's a temporary loss. It's not a permanent loss. But if it's selling at 5 and it's still valued at 15 or 20 that you valued for originally, you can still buy more. And that's what Buffett used to do. Like he used to accumulate as much as possible. Once he knows that something is undervalued, he would just keep buying. And Washington Post is a very good example of that. The intrinsic value that Buffett estimated for that business when he looked at it back in 1973 was that it had an estimate of $400 million, and the market was valuing the whole business at $80 million. And that was such a massive, massive opportunity. And Buffett accumulated a lot of shares in Washington Post because he saw that it was a very, very clear opportunity. And these are the kind of big fat pitches that he would wait for. He would wait for that margin of safety, and he would wait for valuations to be in his favor massively. And these are the kind of bets that Buffett would make where the downside is significantly low, but the upside is massive. And there's another example which comes to mind, which is the American Express stock. So in 1963, there was this crisis that American Express faced, which was the salad oil scandal. What basically happened is that one of the borrowers of American Express fleeced American Express by falsifying documents and scamming them for around $125 million, and which was quite a big number compared to their market cap back then. And it wasn't as big as it is today, obviously. And so Buffett saw that opportunity and he studied it. He looked at two things. So one is whether will this company go bankrupt, and he looked at the balance sheet and he saw that okay, this company is not going to go bankrupt because of this scandal. And the second thing he looked at was are people still using American Express products? So there were two products that were immensely popular then. One was traveler's checks and then credit cards, and they were both growing businesses in the 1960s. And Buffett asked people to go out into restaurants and department stores and see whether people are using these products. And he found that people were still using them. And in fact, the business was growing. And that's how Buffett became comfortable that this is a good business to get into. And American Express, when the salad oil crisis hit, the price had dropped by 50%. And that's where Buffett picked up a lot of stock. He held it for a nice period of 10 years, and he 10xed his money on that. Like he made a nice 58% return per annum on that one bet. And these are the kind of opportunities that he always looks for, where the upside is significantly better than the downside, and there's a lot of margin of safety. So how did this all come together? Like how did Buffett implement all of this together? And the way I look at it is he used these tools or principles to make decisions for him almost, and also to manage risk. So if you look at 5,000 odd stocks that trade on the US stock market, or I think there's 20,000 stocks overall in the entire world. So the way he would cut short that list and make it more manageable or make it more easy to filter out is that he used some of these levers like circle of competence. So if I talk about my own circle of competence, like 95% of the stocks will move out because they're just not within my circle of competence. So he used those benchmarks and levers to cut short that list and just get that no answer. Like when Buffett analyzed the stock, he was looking at getting a no, like at any stage within his deep dive or review of a stock. If he found he doesn't like something, he would just say no and move on to the next one. And that's what these principles help us to do. Like it helps us to give that framework or those decision making tools, saying okay, if it's not within these things that I'm looking for, then I will just say no and I'll move to the next one, or I'll park this one now and come back to it later. And that's what Buffett was doing all the time. Like he was constantly turning over rocks, constantly looking at more and more opportunities. One of the things that Buffett encourages everyone to do is develop that psychological edge as well, where investors need to be patient. Sometimes you need to be a contrarian because the market may not agree and people may not agree with your views. So you have to be patient in those cases as well. And you have to be an independent thinker. You have to be hyper rational, and these things are easier said than done because when you are in the trenches, when you are 50% down, you're doubting yourself. You're doubting whether the market will ever agree with you, or whether the business uh, is gonna get even worse than where it is at. So having that psychological edge is very, very helpful. And one of the things that Buffett always did was he kind of delineated what the market says about the business versus how the business is actually performing. And as long as the business is doing well, as long as it's improving its future prospects, he would be okay to keep holding them, despite what the market says the business is up to, and in that particular period of time. These principles are something that either they will resonate with you or they won't. And if they do, then you would want to know more and learn more. And if you want to do that, like I would suggest going to this 1998 lecture for visual learners. It's 1 hour and 20 minutes of pure gold insights. It's free on YouTube, so these are clickable links. So if you want to, and I'll put them down into the notes as well, so that um, you can check that video out. This book is how I started my investing journey. It's a phenomenal foundational book. And what the author has done is he's compiled the letters of Warren Buffett that he wrote to Berkshire Hathaway shareholders. and he has categorized them based on topics and pulled out the insightful content and put them together in a book. It's a fascinating book. Check that out as well. I've written a few articles on circle of competence, principle of inversion, which Charlie Munger always talked about, compounding, and a few others on my website. Have a read of those if you're interested. There's some other phenomenal blogs. So Farnham Street by Shane Parrish. It's one of the great websites to study investing and know more. Kingswell Substack is quite a good one as well because Kingswell focuses purely on Berkshire Hathaway and the history of Berkshire Hathaway as well as current events around that company. Safal Niveshak is a very good. The website is phenomenal. It has a lot of mental models. Vishal Khandelwal is like an investment coach for I think more than a decade now. So check out his work there. And I've also created a list of 120 foundational books, not just for investing, but also business, history, anthropology, a lot of things like psychology, philosophy, and all those things. So I've compiled that list based on recommendations by Buffett or Charlie Munger or Berkshire Hathaway or Naval Ravikant, Tim Ferriss. There's a lot of people who have recommended books via podcasts that I listen to. So I've compiled them over time and I've created this list, and it's a running list. I'll keep adding more and more to that as I keep progressing on my journey, so that you can get access to that. And it's a free Google Sheets, so feel free to use that for your own book purchasing. And if you want more resources, there's a stock research checklist that I've developed. You can access that on my website for free as well. There's a DCF calculator, which I previously mentioned, which is by Corporate Finance Institute, also for free. So check out those resources if you want to. And that's pretty much it. The event was brought to you by my company, Tiny Tycoon, and we create these beautiful collectibles, be it coffee mugs, T-shirts, wall art, a Warren Buffett figurine, a diary with 160 investing quotes. It's like a notebook or a journal, which I've created from scratch. So I create this kind of interesting merchandise by pulling quotes and caricatures of legendary investing and business tycoons. So check out my website if you guys are interested. And thank you for listening. I hope this was useful and would love to connect. And if you have any questions, feel free to drop them on my email or in the comments below, and I'll be happy to answer them. Thank you for your time.